Hello people, today we are going to learn about accelerated depreciation. So let's see. Double declining balance method. Depreciation in the early years of an asset estimated useful life is higher than in later years. This is because when we buy a new equipment, it functions well when it's new, but as it ages, the real value of the asset declines. So let's see how we can calculate declining balance method. Depreciation expense is equal to remaining book value multiplied by accelerated depreciation rate. What is accelerated depreciation rate? It is also called the double declining balance depreciation, and its rate is 200% of the straight line depreciation rate of 1 over useful life. So straight line depreciation rate is always 1 over useful life. If you multiply it by 200%, you will get the accelerated depreciation rate. Let's do an example to understand more. On January 1, 2003, Basco buys a new boat. Basco pays 24,000 for the boat. The boat has an estimated residual value of 3,000 and an estimated useful life of 5 years. Compute depreciation for 2003 using the double declining balance method. So first we need to calculate the accelerated depreciation rate. So as learned over here, the accelerated depreciation can be calculated as 1 over useful life multiplied by 200%. So useful life is 5 years is given. So 1 over 5 multiplied by 200%, which gives us 40%. So accelerated depreciation rate is 40%. So to calculate for the first year of depreciation expense, we will just use the book value multiplied by accelerated depreciation rate. Book value is given for 2003 is $24,000 multiplied by 40% will give us $9,600. So for 2003 depreciation expense journal entry will be 9,600. 2003 9,600 is depreciation expense. Accumulated depreciation is the same amount because this is the first year. Book value will be calculated uh, as the original book value of 24,000 minus the depreciation accumulated depreciation, which will give us 14,400. So for 2004 we'll use the remaining book value and then again multiply it with the depreciation rate of 40%, and then we'll get the depreciation expense. And accumulated depreciation will be the addition of the 9,600 plus 5,760, and we will get 15,360. To calculate the remaining book value, we will deduct depreciation expense from the remaining book value from the previous year ending. So we will get 8,640. Similarly for 2005, we'll use the remaining book value of 8,650 here and then multiply with accelerated depreciation rate of 40%. We'll get depreciation expense for this year as this much, and then to calculate the accumulated depreciation, we'll just add the previous year accumulated depreciation with the new value. This is the total accumulation. Then we will get this value by deducting a previous book value minus this year depreciation expense. We'll get this value. Another way to get book value is the original original book value minus the accumulated depreciation will give this value. Similarly for 2006 we'll calculate, and we will keep on calculating until we get the salvage value, which is always greater, which is because salvage values cannot be negative. So we keep on depreciating until the value becomes negative, and then we skip that year, and the salvage value comes to be $3,000. So total depreciation over the estimated useful life of an asset is the same using either straight line method or declining balance method. So here is the total value of accumulated depreciation, which is $21,000. So whether you use this method, straight line or declining balance method, you will get the same value. Financial statement disclosures. Estimates of useful life and residual value may differ from company to company. The reasonableness of management's estimate is evaluated by external auditors. Principle of consistency states that companies should avoid switching depreciation method from period to period. So company should decide which one they want to follow. Straight line is straightforward, and declining balance method. It should not switch from this method to this method. It should, based on their yeah, convenience, they should decide on one and stick to that. Revising depreciation rates. Predicted salvage value, predicted useful value. So depreciation is an estimate. Since depreciation is an estimate, sometimes the salvage value is predicted in the beginning, or the useful life is predicted in the middle of the use of the equipment. So over the life of an asset, new information may come to light that indicates the original estimate need to be revised. Let's do an example to understand the revising depreciation rate. On January 1, 2003, equipment was purchased at cost 30,000, has a useful life of 10 years and no salvage value. During 2006, the useful life was revised to 8 years total, 5 years remaining. So calculate the depreciation expense for the year ended December 31st, 2006 using the straight line method. So it started with the book value of $30,000 and useful life of 10 years. To 30,000 divided by 10 will give us the depreciation expense for 2003, and for 3 years from 2003 to 2006. 30,000 divided by 10 is $3,000. For 3 years will be 3,000 into 3 is 9,000. So 9,000 is the accumulated depreciation at the end of 2005 and beginning of 2006, where during 2006 the revision took place, which revised the remaining year to be 5 years instead of 7 years according to the initial estimate. So accumulated depreciation is 9,000 as calculated like this, 3,000 per year, and then remaining book value will be calculated by um, deducting the accumulated depreciation for 3 years from the original book value, which will give us $21,000. Then divide the remaining book value with the useful life. The new predicted useful life is 5 years. So we will divide it by 5 and we'll get the revised annual depreciation of 4,200 um, uh, as the accumulated depreciation expense for each year for the new revised value. This is the method for calculating depreciation. When our estimates change, depreciation is book value at the date of change minus salvage value at the date of change divided by remaining useful life at the date of change. So we have to remember that the formula changes with the date of change. We do not use the original book value, but the book value at the date of change, salvage value at the date of change, remaining useful life at the date of change, not the original one. So the revised annual depreciation gives us $4,200. So guys, I hope you got some insights on declining balance depreciation method or accelerated depreciation. So subscribe to my channel or come back to my channel for more topics on accounting. Thanks for watching.